Excuse me. Now the next relief is going to be gift relief. Now sometimes what happens is that you make a gift to someone. Now when you are making the gift to someone, now you are either not charging anything from them, or you are charging less than what is market value, right? So there could be two scenarios. If I make a gift, I will be charging no money from the person whom I am giving the gift. In the second scenario, if I give the gift, I will be giving the gift, but I won't be charging the market value. I will be charging less than market value. Excuse me. Now in both cases, whatever price I am charging from the donee, whatever price I am charging from my friend whom I am giving the gift, for capital gains purposes, we will always take the market price for capital gains purposes whenever I am giving the gift. Now even if I haven't charged anything, I will have to take market price for capital gains purposes. Even if I have charged 50% of what market value was, I will still have to charge. I will still have to make a market price while calculating the capital gains tax. Right? So I will have to take the market price. Now, although I will have to take the market price, but while calculating the capital gains tax, we can have the gift relief. Now, if we have the gift relief, in that case, amount which I have paid for the gift, so whatever I have incurred on that gift, that is my cost, right? Now, if I am charging anything on top of that from my donee to whom I am giving the gift, whatever is more than my cost, that is going to be chargeable immediately. Now, if there isn't anything, then obviously I won't have to pay anything. Now, let's look at the notes, then you will understand this concept better as well. So, gift relief. On gift of business asset and shares of personal company. Now it could be shares of personal company as well. Now what the personal company is, we'll see later in our companies section. Just leave it for now. Right, so transfer, so whoever is transferring the shares will take the market value, as I said, because we are giving the gift, but for capital gains purposes we'll always take the market value. We'll deduct the cost out of that, and that will be our gain. Now, amount received in excess of cost, whatever my cost was, if I have received anything in excess of cost, that is going to be chargeable gain, and that will be immediately chargeable. And the remaining amount is going to be gain, held over, or you can say gift relief, right? Now, whenever the transferee, whenever the donee sells that asset, now we'll have to calculate the base cost, so cost will be reduced by this gift relief. So if you just look beneath that, for transferee, we'll take the sales and then we'll calculate the base cost. In the base cost, we'll take cost first. Now again, this cost is going to be market value, which we have taken in the sales earlier, so it is going to be market value. So we'll take cost, which will be market value, and it will be reduced by gift relief. Please make sure you put the brackets on side of it, because it will reduce the cost. So cost will be reduced by the gift relief, and then the remaining amount is going to be our chargeable gain. Right? So that was our gift relief. Let's look at the example about the gift relief as well. Bear me 1 second while I take you to page number 64. Now if you come to page number 64, please. So it says, page number 64, yep, gift relief. Excuse me. On 6th of May 2016, A sold to his son Michael a freehold shop valued at £200,000 for £50,000. So its market value was £200,000, whereas he given to his son for £50,000. So while calculating the capital gains tax, we don't have to look at what he actually paid. We'll have to take the market value. So take the market value as sales proceeds. Then how much he paid for it? It says Abe had originally purchased the shop for which he had run his business for £30,000. So that is the cost of Mr. A. So we'll have to deduct the cost out of that, and remaining amount is going to be our gain, right, as you can see on your screen. Right then, now how much he has actually received from his son, more than what he actually paid for it. Now he paid £30,000, Mr. A paid £30,000 for that, whereas his son paid to him £50,000 £20,000 more than what his dad has paid. So this £20,000 is going to be immediately chargeable, and the rest of the amount is going to be deferred. The rest of the amount is going to be our gift relief. Now we'll have to, we'll have to calculate the gain of Michael as well, and for that we'll have to read the question again, the remaining part. So Michael continued to run a business from the shop premises, but decided to sell the shop in March 2017 for £195,000. So we'll take the sales proceeds, £195,000. Then what we have to do is we'll have to take the cost. So while taking the cost, we'll have to calculate the base cost. In the base cost, what we do is we'll have to take market value, of the asset market value when he got from his dad. So market value at that time was £200,000, and what we have to deduct it out of that, the gain, the gift relief, deferred gain or the gift relief which he claimed, we'll have to deduct that out of that, and this is going to be our cost. And the remaining one, if we deduct this cost out of that, the remaining one is going to be our gain. You will have to do these examples again when you reread, when you revise these reliefs. Please make sure you redo these examples which are given on page 60, 64 and 63, I think. Yeah, from page 63 to a couple of pages long. So we'll have to just read one relief, then do an example, then read the relief, then do the example. In this way you will be understanding everything in a better way, right? So one last relief is left which is relevant to our example, and we'll do one example more as well which is left. If you come to page number, we have done this one, page 55 please. It says enterprise investment deferral relief. So EIS deferral relief. When we did enterprise investment scheme, EIS, in our first chapter, we looked at a little bit about this scheme as well, if you remember. If you want to go back, you can do so, but it is given in details here. So let's read this one. An individual may defer a gain arising on any type of asset if he invests in EIS shares. So you can defer any type of gain on any type of asset use. Excuse me. So when you sell any type of asset, you make some gain, and that gain can be deferred if you invest in EIS share. So it is a broad range of options available to you. So whatever asset you sell, if you make any gain, you can defer that gain if you reinvest into EIS shares, right? So the amount of gain that can be deferred is lower off. So it will be, gain will be lower off what? Gain on the asset which you have sold, amount subscribed in EIS shares, or amount specified by investor in his claim. So just leave the third one, amount specified by investor in his claim. It's a bit funny, because if it is up to me to claim, if it is up to me, if HMRC says that how much you want, I will say I want £1 million. So just ignore the third one, because it is lower of these three anyway. So we'll have to take the lower of these three. So it will be lower of gain of gain of asset and amount subscribed in EIS shares, right? Right then it says EIS deferral relief should be claimed within 4 years after the end of a year when the gain to be deferred arose. So it will be 5th of April 2021 for our current tax year. Now the gain, the gain which you have deferred will be deferred until any of the following events happens. So which of the event? Chargeable disposal of EIS shares. If you dispose of EIS shares for a chargeable period, within the specified period, which is the minimum holding period of EIS. The second one is investor becomes non-resident. Now, so if he is no longer UK resident, he is non-resident. And the third one is shares cease to be eligible for EIS shares. So if you just breach any of the EIS shares conditions, then shares won't qualify for EIS. All right. If you come to page number 56, there is another relief which is known as incorporation relief. Now what happens is that sometimes if you're running a business as a sole trader, but you want to sell this business to a company, or you want to make a company, so what you do is you will have to transfer all of the assets to a company, and when you're transferring them some assets, then you will have to pay tax on that. But this tax can be avoided by claiming incorporation relief. Sorry, not claiming, it is automatic, but I mean by having the incorporation relief. So incorporation relief is automatic, so no claim needs to be made. However, an individual can elect not to receive incorporation relief by 31st January, which is approximately 34 months after the end of tax year. So for our current tax year, it is 31st January 2020. But the question is, why would someone not want to have the incorporation relief? Remember, when we started these reliefs, I told you that these are deferral reliefs. What we are doing is we are just deferring the relief. We will eventually have to pay tax on that, but we are just deferring it so that we can pay in the future. We won't have to pay now. So some people, they say that if you have to pay anyway, so why don't pay now instead of paying in a couple of years? So if you want to pay now, so you can say that I don't want to have the incorporation relief. But anyway, how to calculate incorporation relief? We'll have to take sales. So when we are taking the sales, we'll have to take both cash and the shares. Now it says in the notes, it says cost. It is not cost, it is cash. So cash plus shares, and we'll have to deduct the cost out of that. Now when calculating the sales, we are taking both cash and the sales, cash and the shares. But while calculating the incorporation relief will only be available on the shares portion, of the revenue of the sales. So we'll take the gain multiplied by the shares over cash plus shares, and that will be our incorporation relief, and remaining one is going to be our chargeable gain. Right? Now when you sell the shares of the company, then what happens is that so you have transferred these assets to the company, but when you sell the shares of that company where you transferred this business, what happens that then this gain, incorporation relief, will be chargeable because it will be deducted out of the base cost like we are doing for other reliefs. So if you just look beneath that, shares of the company. So we'll take the sales, and then we'll take the base cost, and in the base cost we'll take the cost, and incorporation relief will be deducted out of that, and then the remaining amount is going to be our gain. Excuse me. Next one is held over relief. Now sometimes what happens is that if you had an asset and that asset was insured, in the UK most of the assets are insured anyway. So that asset was insured, but that was destroyed due to a catastrophic event or a natural disaster. So if it was destroyed, so insurance company will pay you some proceeds. Insurance company will pay you some claimed amount. So in that case, if you have reinvested that claimed amount, then if you have reinvested the whole amount, that's fine. The whole amount is going to be your relief. But the amount which you have not reinvested, that is going to be chargeable immediately, in the same way we do for rollover relief. So for rollover relief, we take the sales, whereas for this relief, where the asset is destroyed, whatever the insurance company pays you, we'll take that one as sales proceeds. So we won't take sales proceeds, we'll just write down as insurance proceeds, right? So just look at your notes. So it says sales, insurance, so basically it is insurance proceeds, and we'll deduct the cost out of that, so whatever the cost of the asset was, and then we'll have to deduct the indexation allowance if it is a company, and then amount not reinvested is going to be chargeable immediately, and the remaining amount is going to be our relief. And that relief is we'll have to pay the tax anyway when we sell the replacement asset. Just look beneath that, how we will have to pay tax on that, because this gain will be deducted out of the cost of the new asset. So the cost will be lower, gain will be higher, so we'll have to pay more tax. Right? So the last example which is left, it is relevant to this example. So if you come to page number 63, please, asset destroyed. So it says David bought an asset for £25,000. It was destroyed and insurance proceeds was £34,000. So insurance proceeds is £34,000. We'll take insurance proceeds, we'll deduct cost out of that, which is £25,000, and remaining amount is going to be our gain. Now David spent £30,500 on the replacement asset. Now he has reinvested £30,500, but what he did not reinvest is £3,500. The amount which he hasn't reinvested is going to be chargeable immediately, and the rest of amount is going to be, the rest of the amount is excuse me, the rest of the amount is going to be relief. Now that relief in this case is going to be 5,500, and it will be deducted out of the base cost of the new asset. So we'll take the cost, which is 30,500, and we'll deduct the deduct the relief out of that, which is 5,500, and the remaining amount is going to be our cost for the new asset, right? So that was destroyed assets. Now the last relief is left on page 57, please, disincorporation relief. Now it is just exactly opposite way while we did the incorporation relief. In incorporation relief, what we do is we transfer from a sole trader to a company, whereas in disincorporation relief, what we do is a company transfer its assets and the shares, and it will be run as sole trader. Right? So if you come to page number 57, please. So this incorporation relief applies when the shareholder decides company business to be run as sole proprietorship or partnership. Normally, if a company is disincorporated, then for CGT purposes, all the assets are sold to shareholders at their market values, resulting in a capital gains chargeable to corporation tax. Capital gains tax can be avoided if disincorporation relief is claimed. Now, this relief will be claimed. Now it will only be available if all of the following conditions apply. The business is sold as going concern. All of the business assets are sold, transferred, except cash. Total market value of the land and building and goodwill is £100,000 or less than that. All of the shareholders to whom the business is transferred had held the shares in the company for at least 12 months prior to the date of transfer, and it will only apply between 1st of April 2013 to 31st of March 2018. Please remember that this information is very, very important as far as theory is concerned. Please mark it as important for P6 purposes, because examiner can ask you about this incorporation relief condition. So what are the conditions of this incorporation relief? So you can just write down from A to E. Right, badges of trade. Now sometimes you may be confused that whether you need to pay income tax or you need to pay capital gains tax, because I can say to you, I can give you any asset, say for example this iPad, I want you to ask whether I need to pay income tax on that or I need to pay capital gains tax on that. Now how will I know? This information will help me to decide whether I need to pay capital gains tax or income tax. If a sale is to be distinguished, there is a mistake here in the notes. If a sale is to be distinguished, that whether it is a trading transaction to be treated as income tax or it is asset disposal, which should be treated in capital gains tax, then the following factors should be considered. Now, what are these conditions? What are these factors? So this will decide if I need to pay capital gains tax or income tax. So first of all, subject matter, whether a person is trading or not. So if you are trading, you'll have to pay income tax. If you're not trading, you'll have to pay capital gains tax. It may be decided on the subject matter of the transaction. So it will depend on the type of transaction you are doing. So some assets are held as an investment for their intrinsic value, like painting. So if you have a painting and you might be keeping it for investment purposes, so it could happen like that, but the subject matter may be that cannot be held as an investment. Instead, it is a trading transaction, like 34 million yards of aircraft linen or 1 million rolls of toilet paper. So when someone has ordered 1 million rolls of toilet paper, they're not going to use it for themselves unless their pet is King Kong, but the chances are they're not going to order 1 million rolls of toilet paper. So when they are ordering this much, they are doing it for business purposes, so we'll have to pay income tax. So the next one, it says the frequency of transaction. The more transaction you are doing, it is indication of trading. Less transaction you are doing of the same category, and you will have to pay capital gains tax. Length of ownership. So if you have held that asset for a very short period, then it is an indication of trading. And if you have held this share for a very long period, then it is an indication for capital gains tax. If asset held for long period of time, it is indication of investment. But if the length of ownership is small, then it may be a business activity. Right? So the next one says supplementary work and marketing. So if you bought an asset and you have done supplementary work on that, and you have done some marketing on that as well because you want to sell it. So if I bought this iPad, I'm putting it on Gumtree and eBay. So it means that I bought it for business purposes. Right? So the next one, it says profit motive. So obviously if it is a profit motive, then it is strong indication of business, and you'll have to pay income tax. The way in which the asset was acquired. So if if I have inherited this iPad from my father, then we know that we don't have to pay. It is not a business activity. So if I bought from the market, then I might have bought this for selling for business purposes. But if it is inherited, then chances are it won't be. If you come to next page, on page 58, please, there is a chapter number 17. Please make sure you read this chapter. We will quickly go through in the next video because it is just a theory, and it is very, very important for P6 purposes. You are going to get about 5 to 10 marks out of that. Please make sure you read this. These are just dates which are very, very important. And we will quickly go through in the next video. I will quickly go through with you. So please make sure you read this chapter, and so that you already know what I am talking about, because I will be just quickly going through. I won't be telling you everything in details, right? Because it is just a theory anyway. So that's it for this video, and I will see you in the next video, and we will continue with capital gains tax. Thank you very much, and goodbye.